In this video, we touch on the Japanese yen crisis, the evolution, measures taken, why it's not working, and what the government should do. Let's start with an evolution of the crisis. Historically, Japan has had three interest rates regime. From 1999 to 2012, there was the zero interest rate regime, which birthed the yen as a global funding currency and led to the emergence of the yen carry trade. From 2013 to early 2024, we had another regime marked by massive depreciation in the Japanese yen and accumulation of foreign debt as the BOJ implemented negative interest rates. From 2024, we had inflation gaining traction in Japan, resulting in monetary policy normalization and interest rate hike. What are the key drivers of the crisis? The modern yen crisis erupted in earnest in 2022 and stems from three compounding macroeconomic forces. First, there is the persistent gap between the U.S. Federal Reserve and the BOJ. Even as the Fed paused its rate cuts due to resilient U.S. economic data, Japan's maximum 1.0% rate leaves a massive interest rate differential. The second trigger is Japan's structural energy vulnerabilities. Japan imports over 90% of its fossil fuel requirements. Geopolitical shocks, such as escalating hostilities in the Gulf and closures of the Strait of Hormuz, send crude prices soaring. Because these commodities are priced in dollars, Japan experiences a continuous, non-discretionary trade deficit, forcing commercial entities to sell yen for dollars daily. The third factor is the domestic asset capital flight. Decades of domestic deflation encouraged Japanese citizens to hoard cash in zero-yield bank deposits. However, the modernization of tax-free investment vehicles, like the Nippon Individual Savings Account, NISA, has completely altered domestic behavior. Millions of retail savers are shifting their money into foreign equity index trackers. This individual investment boom has turned the ordinary Japanese household into a primary driver of capital flight. What has been done so far to manage the crisis? First, we have seen growing caution raised by the BOJ to currency traders to avoid overheating the currency. There has also been swap lines between the BOJ and the U.S. Treasury. The BOJ has stepped in periodically in the market to buy domestic bond to prevent yields from spiking in tandem with a fast depreciation of the currency. The government has also implored Japanese pension funds to invest in domestic assets, and Tokyo has explored liquidating some of its holding of U.S. assets to pump USD into the monetary system. If all these measures are explored, why aren't they working? Here's the policy debate. Is the failure of these measures structural or a case of unmet conditions? For those who think the failure of the measures is structural, they argue that the government's current strategy is fundamentally flawed because it relies on contradictory policies. For the opposing school of thought, they believe the measures are right, but the enabling conditions are unmet. This is largely because meeting this condition depends on external variables beyond Tokyo's control. The first position argues that direct interventions to sell USD and buy JPY often results in rising yields, and the BOJ steps in to buy bonds and suppress yields, injecting JPY liquidity back into the system. Likewise, the government is sabotaging the plan through its expansionary budgets. The alternative position argues that to manage the crisis, Fed rates need to come down, but that is beyond Tokyo's control. Core inflation also remains sticky, leaving real yield negative and the carry trade profitable, which continues to weaken the yen. Then the GPIF investing more in domestic asset would trigger a global financial market malaise due to the size of the fund it manages. So, where does Japan go from here? To stabilize its currency, a nation must achieve positive real yields, running current account structures backed by high-value technology and manufacturing sectors, similar to Switzerland or Singapore. Can Japan meet these requirements? First, Japan has a heavy debt load, so the BOJ cannot simply raise interest rates to turn a corner with the real yields, because doing so would raise the cost of financing the overladen government debt. And then Japan's domestic core economy has lost its competitiveness. The country's digital trade deficit is expanding as domestic firms rely heavily on American software infrastructure, while its legacy automotive sector faces structural pressures from global EV transitions. Without a significant shift toward high-margin digital exports, Japan cannot rely on organic trade flows to support the yen. The baseline macro outlook for the yen remains challenging, characterized by extended volatility. The BOJ will likely maintain its gradual tightening path, pushing short-term rates toward 1.5%. However, this tightening will be heavily constrained by the central bank's need to protect the JGB market from spiking yields. In conclusion, the Japanese yen crisis is not a temporary market anomaly that can be solved solely with currency interventions or minor interest rate hikes. Instead, it is a structural challenge driven by a graying workforce, low domestic productivity, and a massive public debt load that prevents the central bank from raising interest rates aggressively. While Tokyo's defensive strategies can help slow the currency's decline, they ultimately address the symptoms rather than the root causes. Until Japan addresses its core economic imbalances or global interest rates decline significantly, the yen will likely remain structurally weak, marking the end of its era as a stable global safe haven currency. Thanks for watching. Hope it was value for your time. Remember to like, share, and subscribe to this channel for more insightful contents.